Have you ever wondered what would actually happen if you invested $500 every single month? At first, it may not seem like much. $500 is not enough to make you rich overnight. It probably will not change your life in the next few weeks. And if you look at your account after the first month, it might feel almost pointless. But over time, that same $500 monthly investment can become surprisingly powerful. The reason is compound growth. When your investments begin earning returns, and those returns start earning returns of their own, your money slowly begins doing more of the work for you. The early years may feel slow, but after enough time, the results can become much larger than most people expect. So in this video, we're going to look at what happens if you invest $500 every month, how much it could grow to over time, and why starting earlier can make such a big difference. My name is Michael, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. Let's start with the basic math. If you invest $500 per month, that equals $6,000 per year. Over 10 years, you would personally contribute $60,000. Over 20 years, you would contribute $120,000. And over 30 years, you would contribute $180,000. That alone is a meaningful amount of money. But investing is different from simply saving cash because your money has the opportunity to grow. For example, if you invested $500 every month and earned an average annual return of 8%, after 10 years, you would have about $91,000. That means you only contributed $60,000, but your investments added roughly $31,000 on top of that. After 20 years, the numbers become much more interesting. You would have contributed $120,000, but your account could grow to around $294,000. After 30 years, your total contributions would be $180,000, but the account could be worth around $745,000. And after 40 years, investing $500 per month at an 8% average return could grow to over $1.7 million. This is why time matters so much. In the beginning, most of the account value comes from your own contributions. If you have $3,000 invested and the market goes up 8%, that is only $240 in growth. It is nice, but it does not feel life-changing. But once the account reaches $300,000, an 8% return is $24,000 in 1 year. At $700,000, an 8% return is $56,000. And at one point, $7 million, an 8% return is $136,000 in 1 year. This does not mean the market will go up 8% every single year. Some years will be much better and some years will be negative. But over long periods of time, investing consistently gives your money a chance to grow in a way that cash usually cannot. The biggest challenge is that the early years can feel boring. When someone first starts investing, they may only see small changes. They put in $500, then another $500, then another $500, and the balance still looks small compared to where they want to be. This is where many people stop. They think investing is not working because they do not see huge results right away. But the first stage is mostly about building the habit. The wealth does not usually come from one perfect investment. It comes from consistently putting money into assets for a long period of time. Another important thing to understand is that starting earlier can be more powerful than investing larger amounts later. Someone who invests $500 per month from age 25 to age 65 has 40 years for their money to grow. At an 8% average return, that could become more than $1.7 million. But someone who waits until age 35 and then invests the same $500 per month until age 65 only has 30 years. Their account could grow to around $745,000. That 10-year delay could cost close to $1 million in future wealth. This is not because the first person contributed dramatically more money. They contributed $60,000 more over those extra 10 years. But the real difference comes from giving compound growth more time to work. That is why waiting until you feel completely ready can be expensive. Many people say they will start investing when they make more money, when life gets less busy, or when they finally understand everything. But investing does not require perfection. It usually requires consistency, patience, and a willingness to begin. Of course, $500 per month may not be realistic for everyone right away. For some people, $500 is easy. For others, it may feel impossible. But the lesson still applies if you start with $50, $100, or $250 per month. The amount matters, but the habit matters too. If you cannot invest $500 yet, you can work toward it. You might begin with a smaller amount and increase it whenever your income rises. You could invest raises, bonuses, side income, or money freed up from paying off debt. The goal is to make investing automatic, so you do not have to rely on motivation every month. One of the best ways to do this is to set up automatic investments. When the money leaves your checking account automatically, you are less likely to spend it somewhere else. Over time, investing becomes a normal monthly bill, except this bill is paying your future self. It is also important to avoid interrupting the process. If you invest $500 every month, but constantly pull the money out for vacations, cars, or short-term wants, the compounding effect never gets enough time to build. The real power comes from leaving the money invested for years and allowing it to grow through different market cycles. There will be times when the market drops. Your account may fall, even though you are still investing. This can feel discouraging, but market declines are a normal part of investing. In fact, if you are investing every month, lower prices can allow you to buy more shares for the same amount of money. This is one reason monthly investing can be helpful. You do not need to guess the perfect time to invest. You simply invest on a regular schedule. Sometimes you will buy when prices are high. Sometimes you will buy when prices are low. Over time, this can smooth out the experience and reduce the pressure of trying to time the market. The type of account also matters. If you are investing for retirement, tax-advantaged accounts like a 401k, IRA, or Roth IRA may help your money grow more efficiently. If your employer offers a retirement match, that can be especially valuable because it is essentially extra money being added to your future. For example, if you invest $500 per month and your employer also contributes money on your behalf, your total monthly investment could be higher than what comes directly from your paycheck. That can speed up the process. The investments you choose matter as well. Many people use diversified index funds or ETFs because they spread money across many companies instead of relying on one individual stock. This can reduce the risk of one bad investment damaging your entire plan. The goal is not to get rich from guessing the next hot stock. The goal is to build wealth steadily by owning assets that can grow over time. What makes $500 per month so powerful is that it sits in a realistic middle ground. It is not an impossible amount for many households, but it is large enough to create serious long-term results. Even if you never become a high-income earner, investing this amount consistently can put you far ahead of the average person. The key is to avoid lifestyle creep. As income rises, many people immediately increase their spending. They upgrade the car, the apartment, the vacations, the restaurants, and the monthly payments. Before long, the extra income disappears, and there is still nothing left to invest. But if you direct part of every raise toward investing before increasing your lifestyle, you can build wealth without feeling like you are sacrificing everything. You do not have to live cheaply forever, but you do need to give your money a job before it disappears into random spending. Investing $500 per month will not make you wealthy instantly, but if you give it enough time, it can completely change your financial future. After 5 years, it may just look like a decent savings habit. After 10 years, it may look like real progress. After 20 years, it may become a major part of your net worth. And after 30 or 40 years, it could be the difference between struggling in retirement and having real financial freedom. The earlier you start, the less pressure you put on your future self. And even if you are starting later, the best time to begin is still as soon as you reasonably can. A single $500 investment may not feel powerful, but $500 invested every month for decades can become one of the most important financial decisions you ever make.